How's it going, everyone? My name is Alex from the Aussie Financial Journal, and happy Australia Day to everyone in Australia. Today I wanted to talk about a little known topic that's going around at the moment. It's basically a debate between dollar cost averaging and a lump sum investment. I want to start out today by talking a little bit about a couple of the pros and cons of these two strategies, and also give you some evidence as to which one would be best mathematically, and also which one would be best if you have a higher risk tolerance. So be sure to leave a like, subscribe, and let me know how you're going in your financial journey. So let's talk about what a lump sum investment is. It's essentially an investment strategy where you take a fixed amount of money and you invest it all up front and all at once. Now obviously there is a brokerage benefit to this in the sense that you only incur one fee for the brokerage cost, so putting all your money up front is good in that way. There might also be a better benefit if you're currently experiencing a bull run, in the sense that the market will be increasing over time, and so you want to have as much capital in the market as early as possible. So that's one benefit of the lump sum. On the flip side, however, you may be hesitant to do this particular type of investment because you're fearful of a market crash. And this certainly could happen if you invest all your cash up front. If the market was to, say, collapse the next week or next month, which is certainly a possibility, you could see the value of your assets decline something like 50 or 60% in a few weeks. This is obviously something you want to avoid, and so that's why a lot of people consider the dollar cost averaging strategy, which essentially combats this fear. So let's talk a bit about what the dollar cost averaging is. So the dollar cost averaging method is essentially a fixed amount of investment paid periodically over a certain period of time. So instead of investing all your capital up front, you set a certain amount of money and you allocate that to a periodic amount every, say, month or so, and you invest in that way. This obviously prevents the case where the market has a huge crash and you experience huge declines in your capital. And since you have that period set, what will actually end up happening is you'll be buying in as the market declines. And so you protect yourself in that way. Obviously, something you'll experience is higher fees and brokerage costs, as for every payment you make, you'll have to incur that cost of brokerage. So how do these two strategies compare with each other? Well, obviously, if you're very fearful and you're very afraid of a market recession or a huge collapse, you would pick the dollar cost averaging strategy. But what we've actually seen in the evidence and in the science is that a dollar cost average is actually less advantageous than a lump sum investment. You actually see better returns if you invest your capital right up front and as early as possible. This is obviously in line with the theory that time in the market is superior to timing the market. And it basically means that investors, while you sit outside of the market, you might be missing out on huge amounts of gains and exposure to good quality returns. Which is why what we've seen in obviously a historically good market run, we've seen that the dollar cost average strategy is actually inferior to the lump sum investment. So there you have it. Those are the fundamental arguments for and against dollar cost averaging and lump sum investing. These should be considered in light of what your personal risk tolerance circumstances are. If you're younger and you have a little bit more time on your side, maybe a lump sum investment strategy might work for you. Just put the money into the market, forget about it for 20, 30 years, and you will see superior returns as opposed to averaging in over time. I'm going to be sure to link you all my research and everything that I've done preparing for this video, just so that you can see other people's ideas about this particular subject. And that's it for today, so thank you very much for listening, and I'll see you guys next time.